Hello, everyone. Let's talk about HIMS and HERS financials. I was making this video late last night. I was prepping, doing my work, and I think I tried to record this like 10 times and just failed every time. And on the last time, it went well, and I forgot to click record. So let's do it this morning when, I'm fresh. So I wanted to cover more the quantitative financial side of HIMS. This is a pretty important thing to do as a retail analyst. A couple weeks back, or a week or two back, I made a video about the qualitative side of HIMS and just how I think about qualitative investment analysis. And I do put more weight on that, but it's important to do these basic valuations and projections when you're evaluating a company and investing. It's a way to make sure everything is in good financial health and the company's still growing and earning and that sort of thing. I will say that at the time I did this yesterday, HIMS, closed 64.22 last Friday, I believe. So this forward PE is based on that price. And for those who are not aware, this morning, Novo Nordisk terminated their partnership with HIMS and HERS, and it sent the stock down about 17% in pre-trading. So what that means, I did the calculations before I jumped on. If you do, I think I saw 53.18 share price. I think I calculated with 87 cents of EPS, TTM EPS, but that's projected. So it's Q2 2025 all the way back to Q3 2024. And that gets you about, what did I have here? Let's see, 61 PE about. So what does that mean? Well, let's go back up here. So here I have Q2 2025 back to Q3 2024 projected revenue growth for that entire 12-month period, about 84%. Then I have forward PE, that was calculated last night. So actually we're going to put the 61 in here. So a little different. Forward PS of 7.1 based on that revenue. And then here, what did I do here? Let's just do 61. So, and then I have PER, which is, it's PEG, but with revenue growth. So where when you do PEG, you're doing PE divided by earnings growth. This is actually PE, price to earnings, divided by revenue growth instead of earnings growth, if that makes sense. And it's a similar metric. However, I use this specifically for high growth companies that are growing over 25 to 30% per year. So HIMS is growing at an outrageous 84% right now, trailing 12 months. So I think under one per is quite amazing. And they're not necessarily optimizing for earnings yet. So as soon as their revenue growth starts to slow down and they start to optimize for earnings growth, earnings will explode as well. And they're already exploding. It's just they're trying to grow subscriber count and grow the business as much as possible right now. And I think that is, even though earnings growth is really, really solid, it could be a lot better, is basically what I'm trying to say. You also have cash to debt here. As of Q1 2025 earnings, it had 322 million and about 60 in debt. So 5-to-1 cash to debt ratio is incredible. I love to see that. I don't really like owning companies that have less than the 2-to-1 cash to debt. That's just how I roll. And just a side note to that, HIMS also completed a senior convertible note offering recently last month for $1 billion on 0% interest. So they have over $1 billion in cash now. Another thing to think about is back in 2021, I believe they projected 1.2 billion in revenue for 2025. They ended up hitting that in 2024, where they actually exceeded it, 1.47 billion for the year, full year 2024. Now they're projecting 2.35 approximately for 2025. And they also put out a guidance for 6.5 billion for 2030. So that makes me think, well, HIMS has outperformed every quarter essentially, except for maybe one or two. And they're giving us guidance. Does that mean they're going to beat again? Are they going to match it? Are they going to smash it? They have a history of severely outperforming their guidance. I love the way that they under promise and over deliver. They just do a really good job of managing expectations, which I think is great for the stock market and for the stock. On top of that, they also just closed an acquisition of Zava, which is kind of like the UK version of HIMS and Hers. That company had about 1.3 million in international subscribers, so that adds on to the 2.4 million existing US subscribers. So that's pretty substantial. And if you think about how HIMS can apply their marketing and personalization, health strategy to international clients, then I think will be a substantial revenue driver for them over the coming 3 to 5 years. And it may impact how they grow. I think a lot of folks think that growth is going to slow down over the next year or two. Maybe, or maybe not. Maybe it stays the same. We'll have to see on that, see how that plays out. Let's go down to this chart for full year projections. Q1, that's already in, so this isn't a projection, that's real. I put in 535 million for Q2, 600 million for Q3, and 600 million for Q4. Did do a ton of work there. I just threw in some numbers just to be conservative. So you can see that ends up being just below their kind of average guide of 2.35 billion for the year, or about 57% revenue growth for the full year. You can see that starts to slow down, like the revenue growth slows down. If they were to only do this amount of revenue in Q3 and Q4, then that's a pretty substantial revenue growth slowdown. And again, we'll have to wait and see on that. This is just guidance. I wouldn't be surprised if HIMS, goes anywhere from 2.4 to 2.7 billion. So I kind of wanted to cover that. This is something I do dedicate time to when I'm researching, deep diving, and investing in stocks. However, the majority of my time is definitely spent on just learning new things about different companies, the products, leadership, all these types of things. But it's important to do financial analysis too, at least some basic stuff. I've flirted with doing discounted cash flows. Maybe I will at some point. This is more my style, what I'm looking at for like a high growth company. I may do something different for a larger company, or, it really just depends. So hope you enjoyed this, and I'll be back next time with something different.